I'm Charlotte McLeod with the Investing News Network, and here today with me is David Garofalo, CEO and Chairman at Gold Royalty. Thank you so much for being here online with me today.
I'm delighted to be here, Charlotte. Thank you.
Yeah, really happy to have you on to talk. And we're kind of picking up from a previous conversation that we had a few months ago, back in September. That was just after it had been announced that the company would be acquiring Abitibi Royalties and Golden Valley Mines. We've now seen that transaction close. So for people who missed the last interview, maybe you could go over that transaction and also plans heading into 2022 now that you've got that under your belt.
Well, what that transaction allowed us to do was consolidate some meaningful royalties in Quebec. Most notably was a royalty on Canadian Malartic, Canada's largest producing gold mine, and in particular, a growing royalty on the underground component of that project. That mine has been operating for the last 10 years entirely from an open pit. It is now investing $1.6 billion in the construction of a new underground mine, which collectively has a resource of approaching 10 million ounces and still growing geologically. And that will contribute about 500,000 ounces a year of production going forward once it's up and running in the next 5 years. And we will have a 3% royalty in a large portion of that deposit. So it's going to be a meaningful source of growth in our cash flows. But more importantly, what that deal did, along with the transaction with Ely earlier in the year when we acquired Ely Gold and its substantial royalty portfolios, collectively, it's brought us to almost 200 royalties across the Americas, with 75% of the underlying value of our business in Quebec and Nevada, where the majority of our royalties are the two best mining jurisdictions in the world, as judged by the Fraser Institute.
Right. So one of the things that we touched on last time was that these transactions that you've done this year are happening in what you believe is a pretty promising gold market. Mm-hmm. I believe you're talking about how you believe we could see a $3,000 gold price, not in the long term, but in the shorter term, kind of within a month's time frame, not years. So I also wanted to review and go a little deeper on that and just hear your argument for why you think that's possible, especially as we sit today still below 2,000.
Well, we just have to look at the headline inflation numbers, and what they're indicating is the excesses that have been introduced into the system really since the last credit crisis back in 2009, when we saw a coordinated effort by the central banks globally to quantitatively ease, in other words, print more money. And that's been unrelenting really since the credit crisis. And now we're seeing the evidence of that in headline inflation numbers. But what I would argue is the headline inflation numbers severely underestimate and understate what real inflation is. It's certainly not 5-6% as the headline numbers would indicate. I think we're all experiencing double-digit inflation in our everyday lives when you consider the cost of food, fuel, the cost of real estate, which has gone up 30-40% in major urban centers. So the cost of living has gone up almost exponentially. And that's because of all of the excess paper that's been introduced into the system. Gold is the one currency you can't print. It's very finite in quantity. It's inevitable that gold will go up. I would argue that it hasn't gone up appreciably because cryptocurrencies have displaced us somewhat, particularly with the new generation of investors that come into the space. But cryptocurrencies don't have the physical properties and indestructibility that gold has. And I think at the end of the day, we're going to see rotation out of cryptocurrencies into gold as the excesses in that system start to deflate.
Right. So this week we did have the Fed have its latest meeting. They seem to be taking some action on inflation right now. We've heard they may speed up the tapering process. We've heard maybe 3 interest rates hikes next year. So how does that fit in with what you see coming?
Well, what's clear to me is that inflation will continue to go up even as interest rates get tight, and it'll take quite a bit of time for that those excesses to be removed from the system. And so we're actually going to see, I think, real interest rates continue to decline deeply into negative territory. And that's simple arithmetic. That's the nominal rate less inflation. Well, we're already deeply into negative territory right now. Short-term interest rates are -4, -5% when you consider headline inflation numbers. And I think actually quite a bit more negative than that when you consider what real inflation is. And I think real inflation will continue to go up, even as nominal rates go up incrementally. And so negative rates will go deeper into negative territory. Interest rates will go deeper into negative territory. That will inevitably drive the gold price up. And there's been an example of this in history. If you go back when Paul Volcker became the head of the Federal Reserve in the late 1970s, when we were experiencing real double-digit inflation, the last hyperinflationary cycle, even as he was raising interest rates, it took a couple of years for real rates to start to go up from negative territory. And gold actually did extremely well at the beginning of that interest tightening cycle. So it really didn't achieve its peak until 1981, a full 2 years after Paul Volcker started introducing higher interest rates. And he was far more aggressive on interest rate hikes than we believe central banks will be in this cycle. They're going to be quite a bit more tentative because they pay much more attention to the level of the stock market than they do real inflation rates.
Okay, so we've got a lot of things going on right now. We have inflation numbers that we can tell are higher than we're being told that they are. We have the Fed with this plan and timeline that it doesn't really look like it's going to be able to follow. So what would your advice for investors be? Where can they look to find true sources of information on what's going on here?
Well, look, I think that what you need to do is anecdotally look at what real prices are doing in everyday goods and supplies. And we're certainly seeing in the mining industry where we're seeing double-digit inflation in capital and operating costs. And we've seen every major producer in the gold industry come out with updated cost guidance on major capital projects, on day-to-day operating costs that indicate that real inflation is quite a bit higher what the headline numbers are. So there are a number of data points you can look at within various industries to see where inflation really is, with not only with the bottlenecks that we have in the system that may be temporal, but because of the excess that has been introduced into the system over the last decade in terms of increased money supply. And so I think gold as an asset class is going to afford investors a measure of protection against the erosion they're going to see in their capital bases as inflation eats into savings. Gold will protect you against that. And then the question that you have to ask yourself at that point as an investor is, how do you best play gold to safeguard your capital and protect your assets? And my argument is you should be in the royalty space. That's why I positioned myself after 32 years of operating and building mines at this end of the spectrum, because it provides you that top line exposure to the upside in the gold price while insulating you entirely from operating capital cost inflation. And that's a concern I have about mine operators right now as well. They'll enjoy the upside in the gold price. They may not get the expanded margins you would expect in an increasing gold price environment because of inflation and their cost basis.
Yeah, that's another topic that I've been hearing come up more and more, is how is inflation actually impacting the mining companies themselves? So maybe we could talk a little bit more about that and where it's manifesting itself. What kinds of costs are we seeing it come up in? Is it affecting major miners, junior miners at the same level? What are your thoughts on that?
Well, every single major mining company has come out with updated cost guidance. When you're looking at Newmont, Agnico, and Barrick, they've all indicated that they're going to see inflation in their input costs, or just their operating costs next year. And every company that's had a major capital project under construction has had to significantly increase their capital budgets. IM Gold on Côte Lake, Eldorado and Skouries in Greece came out with significant updates and increases in their capital budgets for those projects, among others. I'm just giving you a few anecdotal examples, but there are many, many examples, both on the base and precious side, that indicate we are in an inflationary cycle in the mining business. And that's been driven by inflation in the general economy, but I would also argue because of years of underinvestment in new mine capacity, we're starting to see a catch-up in the mining industry and new mine investment, new mine construction to replace depleting reserves and production. And given that there's a finite amount of labor available, finite amount of supplies, machinery, and equipment, we're going to see input cost inflation in a dramatic way against this backdrop of inflation in the general economy, much like we saw 10 years ago as we came out of the credit crisis, when there was a surge in capital investment in new mine capacity. And that was against a backdrop of virtually no inflation in the general economy. So it will amplify the input cost inflation that we saw 10 years ago. I think that will severely erode margins in the mining industry. Again, that's why I think if you want to play gold, I think the best place to be is in the royalty space because of that leverage to the gold price, leverage to exploration without the exposure to input cost and capital cost inflation generally.
Yeah, that was actually one other thing I was going to ask you. All the gold miners in the last bull market kind of faced some criticism about, how much they spent, and it was too much. Going into this cycle, I was hearing that, they're being a little bit better about money. That was before we started hearing all about inflation. So can you talk a little bit about that and, maybe speak about the royalty companies and how that fits in?
Well, the best example I can give you is going back to 10 years ago again, when we came out of the credit crisis and we saw the gold price go up almost 140% coming out of that credit crisis. And so it was a good run for the commodity. Interestingly, the mining equities significantly underperformed the commodity because of that inflation. The mining equities were only up about 60, 70%, so about half of what the commodity was. So it did not provide leverage, or the mining equities did not provide leverage to the commodity. The royalty companies actually increased about 350 to 400% in that same cycle. So it did provide leverage because, again, they provided that top line exposure while insulating their shareholders from input and capital cost inflation. I think we're back into that cycle, back into that inflationary cycle again. I do believe gold is going to do exceedingly well, as it did 10 years ago when there was a lot of monetary stimulus introduced into the system. But again, because of the input cost inflation that we're already seeing in the mining space, I think you're going to see the royalty companies significantly outperform at this end of the cycle. But even at every point in the cycle, we had a nuclear winter in commodities coming out of that last cycle 10 years ago for about 5 years. And all the equities were down, including royalty companies, but the royalty companies on a relative basis still outperformed. And I would say, again, during the bull run that we had over the last several years before inflation started to rear its ugly head, again, the royalty companies outperformed. Mining equities did well, but not nearly as well as the royalty companies did. And again, in this inflationary cycle, you're going to see outsized returns in the royalty space, but maybe not so in the mining equities.
Right. And so as we look forward to 2022, do you have a specific price trajectory that you would expect to see gold go on over the next 12 months?
Yeah, again, I see no reason why we wouldn't achieve that $3,000 an ounce target. And that seems like a significant increase from where we are today. It's over 50% or thereabouts. And I would say, you know what, when it happens, it's going to happen quickly and violently, as it normally does in commodity cycles. It's not a steady upward trajectory to those types of targets. It tends to happen violently. It certainly happened that way in the copper space recently when we saw all-time highs for copper. It wasn't that long ago, literally months, not years, when copper was approaching $2 a pound. And now we've seen it approach close to $5 per pound. When the market starts to react, it reacts quickly and violently to the underlying fundamentals that drive that type of price action. It's not a steady upward trajectory. I believe we're going to see the same type of dynamic in the gold space. I think the catalyst will be a correction in the general equity markets, which are overextended. Multiples really have been distorted beyond recognition. And I would say in the cryptocurrency market, a correction is inevitable there. The valuations there make no sense. Investors are buying it with the expectation it's a reserve currency. It's going to protect them against volatility in the general equity markets. But that is not a safeguard of assets when you have volatility of 40 to 50% in a day. That's not a protector of capital. That's a destroyer of capital. And I think inevitably, given the lack of physical properties, lack of any intrinsic value in cryptocurrencies, I think you're going to see a migration of capital out of cryptocurrencies into gold, which has been a currency physically backed for 4 millennia.
Right, which of course, all of that speaks to the need to be prepared before we actually see those events happen. And I know from reading the comments on our website and our YouTube channel, people are getting a little bit tired. People are, it's been not really even a tough year, but just a year of flatness for gold. So, what would you say to people who are having those feelings right now?
Generally, capitulation like that is a sign that the surge is about to come. It's the darkest before the dawn, and I certainly see that. But these are not dark days for gold. $1,800 an ounce is still a very, very good level. Gold has done exceedingly well relative to other asset classes, and it will do far better because it's always been the canary in the coal mine. It's the one that's been the best barometer of inflation in the general economy. And we're going to see again that migration of capital out of these pseudo asset classes like cryptocurrency into a true asset class, a protector of capital against inflation, which gold has been for 4,000 years.
Okay, so we have a pretty good idea of what's going on with the price for gold, and that's always such a hot topic. I do want to ask before I let you go, are there any other trends that you're seeing in gold or anticipating next year that you would want people to have their eye on and be aware of?
Well, I think we've had years of reserve decline in the industry, down 40% from a peak 7 years ago, simply because the industry hasn't been reinvesting back in exploration and mine development in a meaningful way. That's generally a leading indicator of what's going to happen to production trajectory. So you're going to see a continued decline in production for the industry writ large. Well, that means that if companies are finding ounces, you're going to have to buy them. We've seen some significant M&A of late. For example, Agnico Eagle and Kirkland Lake. We've seen Pretium taken out by Newcrest. You're going to see a continued surge in M&A in the coming year in the mining industry to replace depleting reserves and production profiles because the exploration simply hasn't been conducted to do that organically.
Okay, well, that's everything for me, unless there's anything else that you would want to touch on before we wrap up.
No, that's great. Thanks for your time today.
Perfect, and thank you as much so well. So this is great. Once again, I'm Charlotte McLeod with the Investing News Network, and this is David Garofalo.